Stocks had an incredible run in 2025, and for many investors, it felt like easy money. Portfolios were growing, headlines were full of record highs, and optimism was everywhere. But history teaches us a dangerous lesson. The moments after strong market performance are when investors are most likely to make costly mistakes. When markets rise for a long time, people begin to believe the future will look exactly like the past. They become overconfident, emotional, and careless with their strategy. That is why, as we enter 2026, the biggest threat to your investment portfolio is not inflation, not interest rates, and not even the economy itself. The biggest threat is poor decision making. Insights shared by experts from Morningstar Inc., including Christine Benz in conversation with Margaret Jazz, highlight 5 common mistakes that investors must avoid if they want to protect and grow their wealth in the year ahead. These mistakes are not technical or complicated. They are rooted in human psychology. Avoiding them can make the difference between long-term success and long-term regret. The first major mistake investors make is believing it is too late to invest in stocks. After a strong market year, many people look at rising prices and conclude that all stocks are expensive and that they have missed their chance. They say to themselves, I should have invested earlier, or I'll wait until the next crash. This mindset feels logical, but it is extremely harmful. The stock market is not one single object that moves together. It is made up of many different sectors and categories, including large companies, small companies, growth stocks, value stocks, technology firms, industrial businesses, and financial institutions. Over the past several years, growth stocks, especially large technology and AI-related companies, have driven most of the gains. Meanwhile, small cap and value-oriented companies have lagged behind. This means that while some parts of the market may appear expensive, other parts are still reasonably priced or even undervalued. The mistake is staying on the sidelines out of fear. Cash may feel safe, but inflation quietly erodes its purchasing power over time. Waiting for the perfect moment often leads to missing years of potential growth. A smarter approach is diversification. Instead of avoiding stocks completely, investors can balance their portfolios by including exposure to different areas of the market, such as small cap and value stocks, alongside broad market index funds. This does not mean betting everything on risky assets. It means adding complementary pieces to reduce reliance on one single group of popular stocks. At the same time, investors must understand that small cap and value stocks can be more volatile and cyclical, rising faster in good times but falling harder during downturns. The lesson here is simple but powerful. It is not too late to invest, but it is dangerous to believe that all opportunities have disappeared just because the market has already gone up. The second mistake is ignoring non-US stocks and focusing only on domestic markets. Many investors suffer from what is known as home bias. They invest almost entirely in their own country's companies because those firms feel familiar and safe. In the United States, this problem is especially common because U.S. stocks have dominated global performance for many years. However, the global stock market is much larger and more diverse than any single country. In reality, the world's equity market is roughly two-thirds U.S. stocks and one-third international stocks. Yet most investors hold far less than that in non-U.S. assets, and some hold none at all. This creates a dangerous imbalance in their portfolios. International stocks offer several important benefits. First, they are often cheaper than U.S. stocks on a valuation basis. Second, they provide exposure to sectors that are less represented in the U.S. market, such as financials, industrials, and basic materials. Third, they offer currency diversification, which can help when the U.S. dollar weakens. Over the past year, non-U.S. stocks actually outperformed U.S. stocks, showing how quickly leadership can change in the global market. Some investors now believe that they missed that opportunity too, but this thinking repeats the same mistake of assuming that recent performance means future opportunity is gone. Diversification is not about predicting which country will win next year. It is about spreading risk so that your financial future is not tied to one economy, one currency, or one political system. A globally diversified portfolio is more resilient, more balanced, and better prepared for uncertainty. Ignoring international stocks because domestic stocks have done well is one of the most common and costly errors investors make. The third major mistake is failing to reduce risk when approaching retirement. This mistake is especially dangerous because the consequences can be permanent. Many people nearing retirement still hold portfolios designed for someone decades younger. They remain heavily invested in stocks because the past several years have rewarded that behavior. Stocks have delivered strong returns, and this creates a sense of confidence and even invincibility. But retirement changes everything. When you are young, a market crash is painful but survivable because you have time to recover. When you are close to retirement and begin withdrawing money, a major market decline can permanently damage your portfolio. This is known as sequence of returns risk, which means the order in which returns occur matters. A sharp decline early in retirement can drain savings so much that even later market recoveries cannot fix the damage. That is why reducing risk near retirement is not about fear, it's about responsibility and timing. One useful way to think about this is the bucket strategy. Imagine your retirement money divided into different buckets based on when you will need it. The first bucket covers the next 7 to 10 years of spending and should be invested in safer assets such as cash and high-quality bonds. This bucket is meant to provide stability and peace of mind. Other buckets, designed for longer-term growth, can remain invested in stocks. This structure prevents retirees from being forced to sell stocks during market crashes just to pay their bills. Risk reduction can also be done gradually by shifting new contributions into bonds or cash and making changes inside tax-advantaged accounts where possible. The key is not to abandon stocks completely, but to protect the money that will soon be needed for daily living. Believing that a strategy that worked in your 40s will work the same way in your 60s is a serious mistake that can threaten financial security. The fourth major mistake is obsessing over the Federal Reserve and trying to predict the economy instead of focusing on personal financial timelines. Many investors spend countless hours watching news about interest rates and economic forecasts. They ask questions like, what will the Fed do next? Or, should I wait before buying bonds? This type of thinking often leads to paralysis and poor decisions. The truth is, no one consistently predicts interest rates or economic cycles with accuracy. Trying to time the bond market based on central bank actions usually misses income opportunities and unnecessary risk. Instead of predicting the future, investors should base their strategy on something far more reliable, their own spending horizon. If money will be needed in the next 1 to 2 years, it should be kept in cash. If it will be needed in 3 to 5 years, short-term bonds may be appropriate. If the horizon is 5 to 10 years, intermediate-term high-quality bonds can be useful. Money that will not be needed for 10 years or more can remain invested in stocks. This approach removes emotion from decision-making and replaces guesswork with planning. High-quality bonds are not meant to be exciting or produce massive gains. They are meant to stabilize a portfolio when stocks fall and provide dependable income. Building a portfolio based on headlines instead of personal goals is a mistake that leads to confusion and stress. A good investment plan should be driven by your life timeline, not the daily news cycle. The fifth and final mistake is assuming that past returns will continue forever. Over the last decade, U.S. stocks delivered extraordinary performance, with annual returns around 15%. This has created unrealistic expectations for many investors. Some begin to believe they don't need to save as much, that their portfolio will take care of everything, or that they can retire earlier than planned. This belief is dangerous. Markets move in cycles, and periods of exceptional performance are often followed by more modest results. Assuming that high returns will continue can lead to undersaving, overspending, and flawed retirement plans. A more responsible approach is to use conservative assumptions when planning for the future. Stocks might reasonably be expected to return less than 10% per year over the long term, while bond returns are often close to their current yields. Planning with lower expectations creates a margin of safety. If returns are higher, that becomes a bonus. If returns are lower, you are still prepared. This mindset protects investors from disappointment and financial hardship. Being realistic is not pessimism, it's wisdom. As we move into 2026, the greatest danger is not market volatility, but repeating old mistakes. Believing it is too late to invest, ignoring international stocks, failing to reduce risk near retirement, obsessing over headlines instead of your own timeline, and expecting unrealistic returns are all